Hey guys, this is Leland Baptist, and today I want to talk about something that is super important. And I received these questions earlier today from other people, from other clients, and so I want to go ahead and share this with you all now. All right. So the first question that I received earlier today, it was actually in reference to first-time home buying, right? And this person was basically wanted to know, hey, what's the best route that I should go for a first to buy a first time home? And here's the thing: if you are a veteran, obviously you have access to what's called a VA loan. VA loans, if you don't know what those are, they are typically 0% down payment loans that are used normally to purchase. Now you can use these to purchase or to refinance, but you can only have one VA loan at a time. What's also interesting with VA loans is that, let's say you buy property one using a VA loan, right? And you move, relocate, whatever, get deployed, right? And you go ahead and buy a second home. You can only have one VA loan at a time. And then what also happens is that um, if you want to use, if let's say you take that first property, you refinance it into something conventional. All right. And so now your thought is, hey, I'm gonna just go ahead and use the same VA product again on a third or a secondary home. What the VA is actually going to do now is that they're going to want you to sell this property, that property that you initially purchased using the VA loan. They're going to want you to sell that. All right. So that's the big, that's the caution there. Someone can also use what's called FHA lending. We all know that. That's normally what people consider to be first-time home buying. FHA lending, they've kind of tightened their standards a little bit due to the pandemic, but for the most part, you need to have 2 years of income, and then they have a tier system based on someone's FICO. The tier system goes, um, if you have a 580 FICO all the way to a 619, you're going to be capped at 33% of your disposable income. And that's what they're going to base your monthly payment on. And essentially, that's what they're going to base your pre approval on. Then it goes to a second tier, which is a 620 FICO all the way to a 649. A 649 FICO. So it stops right there, right before 650, right? And so that second tier is now where you are being qualified based off of 42% of your debt to income. Okay, 42%. So in other words, if you earn $100,000 through your job, your occupation, and let's say your disposable income shakes out, you have to be basically qualify for a property that's going to be 42% under what your income would be. Okay, there's more to the calculation that goes to that, but that's basically what you're looking at. And then once you get to that 650 and above, you're actually basing your affordability off of your FICO, and it becomes 50% affordability. So 650 and above, it becomes 50%. Pretty cool, right? So that means someone who's a waiter, if we take three waiters that all earn the same amount of money, but they all have different FICOs, they're each going to qualify for a different amount based on their FICO score. That's just how it shakes out. So that's one thing. The other thing is, if you're not going to qualify through FHA with all of the traditional underwriting, then you have to be a little more creative. So they have different things like jumbo loans and low doc, no doc type of loans. These are normally loans that are used by business owners. So like if you can imagine someone who's a business owner, let's say someone owns a pizzeria, their income may fluctuate year by year, month by month. And so when they're qualifying to purchase a home, there's going to be a lot more of a risk or higher risk tolerance for that business owner. So they may have to use things like jumbo loans and so forth. There are also USDA loans, and then of course conventional. Conventional is what would be considered to be grade B and grade A paper most of the time, and that's where someone has to show consistency in their income and their employment, and they still have to have a fairly strong FICO for most conventional loans. Now, if you have a already established relationship with a I don't know what you call it, like a credit union or something like that, then the credit union will take a little more risk and it'll give you a lower rate. All right. So I hope I covered that question. Right, that was a question I got earlier today. And if you guys have any questions, put them in a comment, and I'll be able to cover those. If not today, then tomorrow. All right. The next question that I got today was, and I got this actually a lot, especially on Facebook. Should you sell? I know you know sell is spelled correctly there, but should you sell? And this is a loaded question, but I want people to really think about this. Whenever you sell your property, especially if it's an investment property, once you sell or disposition, right? That's the fancy word we use in commercial finance or in investments. Once you dispose or disposition your asset, when you do that, that's considered a taxable event. That means that Uncle Sam has the right to tax you on capital gains. Now, of course, someone is always going to say, well, what if I live in my home for X amount of years? Well, if you live in your home, it's not an investment. That's one. But two, even if you live in your home for 1,000 years and you have all this depreciation, you're still going to pay something. You're not going to, and nothing's tax-free. You're still going to pay something, okay, when it comes to taxes. So that's the first thing. So from an investor standpoint, you sell an investment property, you have a few options. You can prepare before the sale and speak to your CPA and structure what's called a 1031 exchange, right? That's something that you can actually structure before you sell. You have to do it before you sell. When you structure your 1031, that just means that whatever equity you're going to capture, whatever cash that you're looking to retain from the property, instead of it being an immediate taxable event, you have a certain time frame after you sell to where you can look for other assets, right? And then take the proceeds that you're getting from your sale and go ahead and use it to purchase another asset. Okay, that's how the 1031 works. But the important thing about this is you have to speak to your CPA. If you don't have a CPA, let us know. We have CPAs that we work with. You can have a discussion with them and see if they're worth doing business with. But you have to have a CPA that will structure your 1031 exchange. Okay. Because within that time period, you have to find that extra property, and then you have to get the paperwork right, and then you're basically deploying your new capital to buy that new asset. Okay, you have to make sure it qualifies and all that stuff. When you do that, that alleviates you from having a large, heavy tax bill. Okay, so instead of having huge capital gains. If you don't do that, here's what you should think about as an investor. You have this property, someone sends you an offer, and if you're not going to do that, if you haven't spoke to your CPA, you're going to pay capital gains. And as an investor, you should think to yourself, like, somewhere between 20, maybe 30% in capital gains is what you're expecting. So if your profit after you pay if you have a mortgage or not, after you pay your mortgage and everything else, and property taxes, you may look at yourself and say, I'm looking at having about $250,000 in liquid. Wrong, you're not. Because you're also going to have to or you should at least, you should set aside money for your capital gains. So really you're not, let's say we do the math, right? And we find out that it's not actually $250,000. It's not $250,000 in cash. It actually shakes out to being about $185,000 or $190,000 of cash, right? So now, after you structure that correctly, you can then say to yourself, is it still worth me selling this asset? Should I sell this asset? Because what most people don't think about is if you're taxed at 30% of your profit, just as an example, and we're doing percentages, which means everything is out of 100, right? So that means that if you're taxed at 30% out of 100, then that gives you 70% in gains, right? That you can keep. So think about that, because the next thing that I want people to think of, if you are going to sell, is would it have been more prudent, more wise, more efficient that instead of you selling the property, and if you had all this fantastic equity, would it be more prudent to leverage the property? Maybe you don't have to refinance and have a cash out. What you could also do is you could go ahead and put a line of credit on this property, on this investment property, right? And in some cases, maybe a home equity line of credit, a HELOC is what we call it, a HELOC on your primary, right? And now that becomes an additional avenue, an additional stockpile that you could use for investing. That could become an additional hedge that you could have, you could have access to. When you do that, you don't pay gains on that. As a matter of fact, you're going to receive more tax benefits. One of the things that I love helping clients with, especially those who are physicians and athletes, because they get taxed the most, is, and this is something that most investors understand, but a lot of doctors don't understand this. The reason that someone is taxed so high is because it's active income. When you refinance, especially when you refinance an investment property, the amount of money that you receive as a refinance, right? That line of credit, that cash out, whatever, that's debt. Okay, DEBT. That is debt. That debt will actually offset your taxable income. So now the money that you're receiving from going ahead and having that refinance, it's tax free. And as a matter of fact, if you look closely when just about tax law, the interest, right, those payments, and in some cases, the property insurance, those things are also tax deductible. So when I hear people say things such as, oh, I want to go ahead and just get a lower rate because, I don't know. There's always some reason. I want to get a lower rate for blah, blah, blah. Yeah, that's fine. Get a lower rate. But have you looked at it from a holistic standpoint? Once you get this lower rate, is that going to increase your taxable income? If it does increase your taxable income and you're not going to do anything with it, you're not going to deploy that extra money to more investments to lower your taxable income, you're shooting yourself in the foot. Because the whole point of investing is one, of course, the whole point of investing is to prepare yourself for the future. The biggest thing that will hold you back from propelling yourself forward in the future will always be the amount of taxes that you're paying. That's the biggest hurdle. As a matter of fact, if the new tax law passes, there's going to be an estate tax at 45%. And that's just federal. That means that if your great grandmother, your grandmother, whomever, that you're an heir to, let's say they leave you $3 million, all right? And this could be in $3 million in the forms of assets. It could be in the forms of cash, could be in forms of equities, right? Stocks, funds, etc. Well, the estate, if they haven't done the correct planning for it, your estate tax will be 45%. 45% federally. That's not including what you're going to have for your particular state or their state or whatever else. That's just basically just cut that in half, right? That's what's going to hold back building wealth. The taxes. So if someone's thinking, oh, I want to go ahead and get as much income as possible, why? Your focus is wrong. That's not the focus. If anything, you should think about how to get more passive income, but not more active income. Especially with entertainers. And you may, I don't know if you guys are noticing this or not, but it's pretty plain and it's out in the open. Entertainers, doctors, athletes, they're paying 50% taxes. That's basically what they're paying because it's active income. When you deploy that income and you make it into passive income, that's where your tax is lower, right? The way the tax code is set up, you're really only, for the most part, you're getting taxable benefits for two things and two things only. It's either one is the capital they're receiving, are you using it to deploy or create jobs? That's number one. And then number two, are you using that income or that money, that disposable income, are you using it to go ahead and provide housing? That's how the tax law is built, right? So going back to that question that someone asked me on Facebook, should they sell their property? I would say no, unless you absolutely need it for personal reasons, things like that. No, that's not a sound decision. If you have the proper credit, if you have the proper knowledge, you have the proper network, what I would suggest that you do is refinance the property. And then what I'll also suggest is go ahead and put a line of credit on the property, because what is going to happen is that as people are overpaying, right? People are overpaying right now astronomical rates for property, especially for property. What you should do is right now is the best time to get some type of lending line of credit against that property, right? Because you have extra equity in it because people are already overpaying. So you have more equity as your property is growing. And hold, wait. Don't use the equity, just wait. Because whether it's the end of this year or the end of next year, when prices cascade down, you can tap into that equity and then purchase all those same properties for discounts. Just be prudent. Just be prudent. Be wise. Wait. You don't have to wait. If anything, what this should show us in the market is that the actual cash today is dwindling at the fastest rate ever. So why would you rush to get more of the dwindling cash? Why not have the ability to leverage it at a later time, right? And for the final question for today that I have from someone, should they buy? Should they buy? If it's a good deal, yes. If it fits within your investment criteria and your principles for investing, yes. If it does not fit within your principles of investing, don't do it. Before the pandemic happened, people were raving about the 1% rule when it comes to investing. The 1% rule, the 1% rule. Now that we're dealing with a shortage of assets, and a matter of fact, what's interesting is real estate is not the only asset that has skyrocketed, right? People who love equities have skyrocketed. Bitcoin has skyrocketed. And the question I want to give you guys is profit made, or is it more prudent? Is it more wise? Is it more important? Is it more worthwhile for you to purchase as something's going up? Or is it wiser for you to purchase when something is going down? Right? Think about it. So if that's the case, why is it any different? Right? So depending on what your criteria is, and depending on what your foundation is, and depending on what those sound principles that you have, follow that. Just because it's a pandemic doesn't mean that your principles have to change. Follow that. Be prudent. If it does not fit your criteria right now, don't squeeze it to make it so. All right? Because once that tide comes in, you're going to see what's truly there on the market. Okay? So those are the 3 questions that I had last night and today from people on LinkedIn and on Facebook. So I wanted to share that with you guys right now. Just want to review real quick. One of the questions earlier today was about first-time home buyer. The next question was a reference to should someone sell at the moment. And the last question is, should you buy? So, and I just want to touch on this one more time. If it's within your principles, if it's within your criteria to purchase, go for it. But if it's not, let's be wise, people. All right. Thank you so much for your time. If you have any questions that you'd like me to answer, please go ahead and shoot me a message or put them in the comments below. and I'll be happy to do that. Talk to you guys later. Peace.